What's up, everybody? Dave, the Military Millionaire here, and today I wanted to just briefly talk to you about the difference between a syndication and a REIT, or a real estate investment trust. And I get this question every now and then because both of them buy apartment complexes, both of them you can invest your money in, and there's some pros and cons to each. So first, the real estate investor trust, some of the pros to that are it doesn't need you to have $25,000 or $50,000. You don't have to have a huge amount of money to invest. You can pull your money out. You don't have to necessarily sit in a deal for 5, 6, 7 years. And, you can invest in multiple different deals. You're investing with a big company that maybe they are on Wall Street and they've got a pretty solid reputation. So those are some of the pros. Some of the cons, they have exorbitant fees. So they are charging out the ass for what they're doing. So they have high fees. You don't really get to pick the deal specifically. Maybe some of them you do, but usually you're just investing in a big fund and then that fund is buying real estate. You don't really get the same depreciation benefits. You get some, but it's just different. And you don't have any idea who's managing the property, right? Some of these bigger companies can run higher expenses because, yeah, they're big, they're corporate, they're whatever, but they're corporate, so they got issues, they got slow processes, they got this, they got that. They might not care about the apartment as much on the small level as you or I or someone managing a deal would. And then you don't really know the managers. You know who the team is, but it's not like you can build a relationship with the people who are managing the deal. And to me, that's huge. I think the biggest piece about investing in an apartment complex, other than just understanding the deal itself, specifically that deal, not a fund in general that fluctuates and has more volatility in like a REIT, but knowing the people who manage the deal, right? I want to have a relationship with the people managing the deal and know that they're the type of people who are going to succeed when crap hits the fan, not struggle and not fail and not crumble and not whatever. So I think that's a big con. On the syndication side, some of the cons, and I'll start with cons first because I think there's fewer of them. It might take more to invest. I've heard of people accepting as low as $10,000 into a syndication deal, but it's usually $25,000 or $50,000 that they want as a minimum investment. $50,000 is usually the case. That's been the case on 2 of my last deals. 25 is acceptable too, but you're going to need a little bit more money. I guess you have to wait for a deal to come around. That could be a con, right? You don't want to just throw funds in. You got to wait for a good deal to come along that you like instead of just throwing money into a fund. I don't know if that's really a con because that means you're looking for a good deal. You can't just pull your money out randomly all the time. You're not investing in a fund, you're investing in a building, and that might be a 5-year hold or whatever. So, make sure it's money that you can afford to not be messing with. Yeah. Some of the pros, you get to build a relationship with the people managing the deal. That's huge. That is absolutely the biggest difference for me. I want to know who's managing the deal. I want to have a relationship with them. I want to be able to reach out and talk to them. I want all of that. So there's that piece. And then you get to invest in a specific deal. So you get to see the yeses and nos, and you can decide not to invest in this deal if you don't like it, but then turn around and invest in this one instead of being in a fund that buys both. And so you can pick and choose which deals you put money into based on your specific criteria, whether you want to be more cash flow oriented or appreciation oriented or whatever the case. Man, there's just so much good stuff. Depreciation, you get a lot of tax benefits. You get to benefit from all 4 pillars of cash flow, like buy and hold real estate, cash flow, debt pay down, appreciation, and then depreciation, the tax benefits. So that's big. There's just a lot of good things about syndications. Mainly for me, it's analyzing specific deals, knowing the team members, and then tax benefits. Those are all huge. But there's just a lot of benefits to syndications. I'm a huge fan. You can reinvest your money in that same team and other deals. And I actually like the fact that you can't just pull your money out, because if you get emotional about something, you're not going to just yank your funds. You're going to leave them in there because that's what you have to do, which keeps you from emotionally pulling your money out of a good thing and missing out on opportunity. But it also, I like to run lean, so I would rather put $100,000 into this property and then only have $10,000 to survive on for a while than have the ability to pull the money back out when I want to buy something. This forces you to run lean on your personal finances so you can build your business assets, which ultimately will take care of you down the road. But you got to have that delayed gratification ability to push off the returns and push off the money to later to really build that, so that as you get closer to retirement age or whenever you want to retire or whatever, you have funds. If you spend all your money now and you tap into your investment capital, you're going to be hurting down the road. But if you invest later or invest everything and you live very lean now, then you can live like a king later, right? Like, think about just $100 compounded, I don't know, 3 times is $600, right? Well, sorry. If you have $100, in case I forget to edit this out, doing math in public, I apologize. But if you have $100 and it doubles 3 times, so that 100 becomes $200, $400, and $800, right? It's very easy to double your money 3 times over the course of time that you're investing. In fact, it should be more than that. But if you spent that $100, you ain't got shit. So in essence, you spending $100 right now is giving up $800, $1,600, $3,200 down the road. So the ability to keep your finances lean and leave that money in a deal, I think that's huge. So real estate investment trusts have their place, and they're good for you if you don't have a huge lump sum or you're okay with a little volatility, you want to diversify a little bit. But if I was going to diversify into a fund like that, I would do an index fund, like a real diversification. Go into the stock market, do index funds, maybe like a Vanguard fund. You should be investing in the thrift savings plan already. That's another video for another time. But some of those different options. And so I would say that if you're going to diversify, don't do real estate investment trusts. Do index funds and stock markets and something that's a completely different sector and style of investing. And if you're not going to diversify and you want to keep it in real estate, then don't do a real estate investment trust. They might work for you, but like save up for a syndication or do some private money lending or do your own real estate deals. But I'm just not a huge fan of the real estate investment trusts, and hopefully nobody from the Wall Street comes and hunts me down because of this. But those are my thoughts on syndication versus real estate investment trust. Let me know what you guys think. And I'd love it if you could just smash the like button if you got something out of this video, and subscribe to the channel so that we can get more information out there down the road. Thanks. Have a great day.